Howdy, Jacob here. Today we're looking at Docusign in the software industry, 11.2 billion market cap on 10.3 billion enterprise value. They provide electronic signature solutions globally, founded in 2003, so they have been around for 21 years, and I've used them in a lot of leases, a lot of, legal documents that require online signatures. I think that, they definitely have a dominance there. They're pretty known for that, and their gross margins have improved from 71% to almost 80%. Still trying to find that operating margin, but their return on invested capital also low due to the fact that they don't really make a lot of money yet on the operating margin side. We'll see on the free cash flow side whether that's different though. So the income statement shows 539 million in R&D versus 2.762. So 539, 2.762. That's 20%. Okay, so a pretty good percentage of taking money away from today to hopefully get more in the future. And of course, that's going to dampen your margins because you're spending a lot, 20% of revenue on R&D. And so hopefully that money turns into more efficient in the future, more revenue, more earnings, and increase the bottom line as well. And so I'm not really concerned about them not making too much money right now because they're still in massive growth stage, which we can see through revenue growth, although the last 2 years have been much lower at 19% and 10% year-over-year revenue growth. The balance sheet has over $1 billion in cash-like products with no short-term and no long-term debt. So very safe from a balance sheet perspective. Cash flow statement has massive production of free cash flow with their stock-based compensation being very high, but they are buying back shares to somewhat offset that, but not entirely. A lot of money going to share repurchases, a little bit to acquisitions and reinvestment as well. So let's make some assumptions here. So for revenue growth, I do think they'll be able to grow at 10%. I think a 20 PE makes sense to me at the end of this period. I think they will be able to get to 15% margins. That seems reasonable to me. And then 1% is about 110 million. I think they'll be able to buy back, if they spend half their free cash flow on share repurchases, that would leave about a 1% increase of shares. So we're saying the company's stock price needs to fall 42% before you get the return we look for here. I think this could also be an acquisition play. So, we don't know anyone who's trying to buy DocuSign, but I think that it easily could be, given the fact that, it sounds like a very simple model and they already have a lot of revenue here. They could definitely have a dominance in my eyes. But again, will they be able to sustain this growth? I guess we'll have to see. But given my current assumptions, I'll still be waiting. But this could be a company that you buy at a little bit of a premium and still get a good return if you're very confident in understanding this business and knowing that's going to be around for a while, as the growth rate is pretty significant. So hope you enjoy the video and have a great rest of your day.